Experts are worried about the stability of the U.S. banking system and how it might affect the housing market. Hello, and welcome to today's video on banking instability and the housing market. In this video, we will be discussing the three major impacts of banking instability on the housing market. Recently, some banks, including Silicon Valley Bank and Signature Bank, collapsed, causing investors to withdraw their money from smaller banks and move it to bigger financial institutions for safety. Before we dive into how this could hurt the housing market, let's discuss what banking instability means. Banking instability refers to a situation where there is concern about the stability of the banking system. It can occur when banks collapse or when investors withdraw vast sums of money from regional banks and move it to bigger financial institutions for safekeeping. The impact of banking instability on the housing market can be significant. Here are three ways it can affect the housing market. 1. Impact on home builders and mortgage lenders. With an uncertain economic outlook, experts worry about the availability of credit for home builders and mortgage lenders, which could hurt the housing market. Many builders have used rate buy-downs, price cuts, and other incentives in their financial arsenal to bring down the cost of new construction to boost sales. However, that may come to an end as borrowing becomes more difficult. The availability of credit for home builders and mortgage lenders is likely to hit home builders, which could hurt housing supply. 2. Impact on housing supply. With the U.S. already experiencing a housing deficit, the squeeze in credit availability could continue to keep the cost of homeownership high as supply remains tight. The U.S. is short of 2.3 million homes, according to calculations by Realtor.com. The availability of mortgages for home buyers is a different story. 3. Impact on home buyers. Over the last decade, small domestic commercial banks have ramped up their mortgage business. However, now the uncertain economic outlook doesn't necessarily mean bad news. Concern about job security amid a recession slows demand, which pushes sales down, and smaller banks may be more reluctant to lend given their need to boost their reserves. Yet, a slower economy helps lower mortgage rates. Concern about a recession, which indicates the possibility of the U.S. Federal Reserve backing off of aggressive rate hikes, pushes investors into the 10-year Treasury, which then pressures mortgage rates downwards. As rates drop, buyers are returning to the market, private data reveals. According to Redfin, a record number of would-be buyers locked in a rate as of Friday with its mortgage lending company than any other day so far in 2023, and mortgage demand overall jumped in the last week, according to the Mortgage Bankers Association. Ultimately, banking instability can have an impact on the housing market, particularly on home builders and mortgage lenders. The availability of credit can affect housing supply and keep the cost of home ownership high. However, it's not all bad news for home buyers, as a slower economy can lower mortgage rates and make buying a home more affordable. That's all for today's video on banking instability and the housing market. Thank you for joining me, and I hope you found this informative and useful. Be sure to like and subscribe to avoid missing out on more. Also, feel free to share your thoughts in the comment section below.